Decoding the economic symphony. Leveraging macroeconomic indicators, with a focus on gross domestic product, GDP, in investment analysis. In the vast landscape of investment analysis, the role of macroeconomic indicators, such as gross domestic product, GDP, stands as a guiding beacon for investors seeking a comprehensive understanding of economic health and potential investment opportunities. The intricate dance of economic indicators can be likened to a symphony, with each instrument representing a facet of the broader economic picture. Among these instruments, GDP takes center stage, offering investors valuable insights into the overall economic performance of a country and serving as a linchpin in shaping informed investment decisions. GDP unveiled. At its core, GDP is a quantitative measure of the total economic output of a country. Comprising the sum of all goods and services produced within a nation's borders, GDP encapsulates the heartbeat of economic activity. Investors keen on unraveling the complexities of investment markets turn to GDP as a foundational metric, providing a snapshot of economic health, growth trajectories, and potential risks. The three faces of GDP. GDP manifests in three distinct forms, each offering unique perspectives for investors. 1 * GDP at market prices, *. This measure accounts for the total value of all goods and services produced within a country's borders, factoring in market prices. It serves as a comprehensive gauge of economic output, encompassing both tangible and intangible contributions. 2 * GDP at factor cost, *. This variant delves into the costs of production, stripping away taxes on products and including subsidies. Investors examining GDP at factor cost gain insights into the efficiency of production processes and the impact of government interventions on economic activity. 3 * real GDP, *. Adjusted for inflation, real GDP provides a more accurate representation of economic growth. Investors relying on real GDP can assess whether the observed growth is a result of increased production or merely a reflection of rising prices. Strategic timing and GDP. Investors must be attuned to the temporal dynamics of GDP data. While quarterly GDP reports offer snapshots of economic performance, the annual GDP figures provide a more comprehensive view. Savvy investors time their analyses to coincide with these releases, leveraging the latest data to inform their investment strategies. For example, consider a scenario where a country's GDP growth rate surpasses expectations in a given quarter. Investors observing this uptick may interpret it as a signal of economic vitality, potentially leading to increased consumer spending, business investments, and a positive climate for equities. Conversely, a lower-than-expected GDP growth rate may prompt investors to reassess their portfolios, anticipating potential challenges in the economic landscape. GDP and investment sectors. One of the key strengths of GDP lies in its versatility, offering investors insights into the performance of specific sectors within an economy. By deconstructing GDP components, investors can discern the relative strength of industries such as manufacturing, services, and agriculture. For instance, if GDP growth is predominantly driven by a surge in manufacturing activities, investors may explore opportunities within manufacturing-related stocks, anticipating potential gains in companies poised to benefit from the industrial upswing. Conversely, if the services sector is the primary driver of GDP growth, investors may pivot towards sectors such as technology, healthcare, or finance, aligning their portfolios with the prevailing economic trends. The ability to identify sector-specific trends within the broader economic landscape positions investors to allocate their resources strategically, optimizing returns based on the shifting currents of economic activity. GDP and inflation, the tug of war. In the intricate dance of macroeconomic indicators, the relationship between GDP and inflation is akin to a tug of war. While GDP reflects the pace of economic expansion, inflation measures the rate at which prices rise. Investors scrutinize this interplay, as an overheated economy characterized by high GDP growth may also signal a potential surge in inflation. In such scenarios, investors may pivot towards assets that traditionally serve as hedges against inflation, such as real estate, commodities, or treasury inflation-protected securities, TIPS. Conversely, if GDP growth falters and the specter of deflation looms, investors may adopt defensive strategies, favoring assets with stable returns, such as dividend-paying stocks or government bonds. The nuanced understanding of the GDP inflation dynamic equips investors with the foresight needed to navigate diverse market conditions and position their portfolios for resilience. Global dynamics and GDP. In an era of interconnected economies, investors must cast a global gaze when assessing the significance of GDP in investment analysis. Cross-border investments, international trade, and geopolitical events all contribute to the intricate tapestry of global economic dynamics. Savvy investors leverage GDP data not only for individual countries but also for a comparative analysis across nations. Consider a scenario where country A experiences robust GDP growth, outpacing its peers. Investors analyzing this data may identify opportunities for investments in companies with global exposure that stand to benefit from increased demand for their products or services. Conversely, if a major trading partner of country A faces economic headwinds, investors may exercise caution, anticipating potential spillover effects on the domestic economy. Conclusion. In the symphony of investment analysis, macroeconomic indicators, with GDP as the lead conductor, orchestrate the melodic interplay of economic variables. Investors attuned to the nuances of GDP gain a deeper understanding of economic health, growth trajectories, and potential risks, empowering them to make informed decisions in the ever-evolving landscape of financial markets. As the economic symphony unfolds, investors armed with the insights derived from GDP data navigate the complex currents with confidence, positioning their portfolios for success in the dynamic world of investments.